In today's video, we are going to be talking about chart patterns. Chart patterns are tools used by traders to analyze the forex market, to be able to identify the directional movement of the market. Price action traders use chart patterns to identify directional movement of the market, to know where the market is going so as to join. They use this technical analysis to be able to predict what the market will be doing. So chart patterns are popular tools used by traders to identify potential price movement in the market. That is to say, forex traders use chart pattern to identify potential movement in the forex market. They use the chart pattern to be able to know what is happening in the market, to know when to buy and when to sell and when to stay out of the market, and have it at the back of your mind that chart pattern is a part of price action trading strategy which traders use to analyze the market, making use of historical patterns that has happened in the past so as to use it as an edge against the future. So they use chart patterns to know what the market will do next. So we have two major types of chart patterns. We have the reversal chart pattern and we have the continuation chart patterns. The reversal chart patterns tells us when a trend has ended and a new trend has begun. It helps us to know a change in trend. That is what the reversal chart pattern does. So with the help of the reversal chart patterns, we will be able to know when a trend has ended and when a new trend is about to begin. But when we talk of the continuation chart pattern helps us to know when a trend is resuming, because when the market is trending, it normally pauses, right? So the continuation chart pattern tells us when the trend will resume. That is the difference between the reversal and the continuation. The reversal tells us when the trend has ended and a new trend has begun. So with the reversal chart pattern, we'll be able to know when a trend is about to change, when a new trend is about to begin. While continuation chart pattern tells us when a trend is about to continue in the same direction. So the difference is that reversal chart pattern, the trend will reverse into another trend. If the market is in an uptrend, it can reverse into a downtrend. If the market is in a downtrend, it can reverse into an uptrend. That is what the reversal chart pattern tells us. But the continuation chart pattern tells us the continuation of a trend. So if the market is in an uptrend, after some time, the market will make some pause, some retracement or some range before the uptrend begins. So with the help of the continuation chart pattern, we'll be able to know when the trend has resumed. So that is what the continuation chart pattern is telling us. So by identifying these types of patterns on a trading chart, traders can gain insight into potential price movement and adjust their trading strategy. So with the help of these chart patterns, traders will be able to gain insight about the potential price movement, and this will help them to adjust their trading strategy. So what we're going to do today is we're going to focus on the reversal chart patterns. That is what we're going to focus for today. Then in our next video, we're going to talk about the continuation chart pattern. So I'm going to share an example with you. So when we talk of the reversal chart pattern, we have so many reversal chart patterns. We have so many, but the most relevant ones are the ones I'm going to be discussing in this video, the ones that have high probability signal. We have so many chart patterns, but the problem is that most of them are not reliable, right? There are so many, most of them are not reliable. So that is why I decided to pick out the most reliable ones, the ones that traders are using, the ones that is making money for traders right now. So pay clear attention so that you understand how to spot this chart pattern and how you can be able to trade them in the forex market. So now when we talk of the reversal chart pattern, we have about 6 reversal chart patterns. For the reversal from an uptrend to a downtrend, we have the double top, we have the head and shoulder, and we have the rising wedge. So these 3 chart patterns help us to know when an uptrend has ended and when a new downtrend is about to begin. Then we have the double bottom, we have the inverse head and shoulder, and we have the falling wedge. So this chart pattern tells us when a downtrend is over and a new uptrend is about to resume. So now we are going to go into details one after the other so that you understand how this chart pattern works. Let's start with the double top. This is how the double top chart pattern looks like. It looks like M. That is how it looks like. So for you to be able to identify the double top chart, you should be able to look for a double touch, the first touch and the second touch. So it should form something that looks like M. So once you are able to find something that looks like M on the resistance level, that tells you that there is going to be a reversal. So here there was a rally, buyers were pushing the price up from here. You can see the price was going up, and normally an uptrend consists of series of higher high and higher low. That makes up an uptrend, right? It means that the market structure is still in place. So when you see several higher high and higher low, it means the market is in an uptrend. So in that case, the price is breaking previous highs, breaking previous high, right? So this tells us that the market is in an uptrend. So now for the fact that the market is in an uptrend and then got to a resistance level, instead of the price to make another higher high, the price made the same level of high, because normally in an uptrend there's what we call higher high and higher low. So when we have a higher high, we have a higher low. So the next one will come will be a higher high. So the next high should overtake this high, right? Should overtake this high, should be on top of this high. So that tells us that the market is still in progress, the uptrend is still in progress. So for the fact that the price makes a higher high and a higher low but couldn't make another higher high, rather the next high was equal to the previous high, and then the price now makes a lower low, right? So once you identify this type of pattern on a price chart, you should know that the market is about to reverse. So we have the top, the first top, the second top, and then we have the neckline. So the neckline now acts as a support level, while the two tops act as a resistance level. If the price, after testing this neckline, went up and formed the double top pattern and then comes down and breaks below the neckline, when the price breaks below the neckline, it tells you that the market have changed direction. This is what we call a break of market structure. So it tells us that the market have changed direction. So what you will do is you wait for the candlestick that caused the breakout, right, to close. Once the candlestick that caused the breakout to close, you place a sell trade at the close of that candlestick, and then your stop loss will be above the neckline, or your stop loss can be at the resistance level, and then your take profit should be at the previous low. So this is how you trade using the double top pattern. So this is clearly a reversal chart pattern from an uptrend to a downtrend. So the next one we have here is what we call the head and shoulder pattern. The head and shoulder pattern consists of the shoulder and head. It consists of two shoulder and one head. That's why we call it head and shoulder pattern. So this is what we call the shoulder, this is what we call the shoulder, and this is what we call the head. So this is the left shoulder, and this is the right shoulder. So and this is the head. So this make up the what? This is the left shoulder, this is the right shoulder, and this is the head, and this makes up the head and shoulder pattern. So now for you to be able to identify the head and shoulder pattern, you should be able to identify it at where? At the resistance level. Now the market was clearly in an uptrend. You can see this long move. This is clearly in an uptrend. Like I said, when the market is in an uptrend, the market makes higher high and higher low, higher high and higher low. So this indicates that the market is in an uptrend. So right now you can clearly see that the market makes a higher high and then makes a higher low. Then the market now makes another higher high. You can clearly see that the next high was above this previous high, right? It engulfs above this previous high, right? Now the market now came back now and makes another lower high. Now instead of the market to make another higher high that would engulf above this previous high, the market makes a lower high, right? So this is a lower high. So this high and this high became equal. The height became equal, right? And now the price could not get to this head, and thereby forming what we call the head and shoulder pattern. So once you see this type of pattern on a price chart at the resistance level, it tells you that the buyers are finding it difficult pushing the price up, right? Because when the price got to this resistance level, this highest high, the price could not break above it, right? The price went down. Instead of breaking above it, it couldn't even get to it. Instead, it reversed from this previous high, right? Forming what we call the head and shoulder pattern. So once you are able to identify this, you simply use your horizontal line and draw the lows. You connect the lows. So the lows becomes what? The neckline, right? So the lows becomes the neckline. In other words, you can also call the lows support level. So this is a resistance level and this is a support level. So in other words, you can call it a neckline or a support level. So what you are waiting for now is for price to break below the neckline for you to take action. So if price eventually breaks below the neckline, what you will do is you wait for the candlestick that caused the breakout to close, because sometimes you may receive a fake breakout because the price can break out. Instead of the candlestick to close, it will now reject and form a wick. So once it closes above the neckline, it means the uptrend is still in progress. So that is why it's advisable you wait for the candlestick that caused the breakout to close for you to confirm that the breakout has actually happened. So once the candlestick that caused the breakout closes, you enter a sell trade here, and your stop loss will be above the neckline or at the previous resistance level, and then your take profit will be at the previous low, right? So you look out for the previous low. That should be your take profit. So once you're able to identify this at what? At the resistance level during an uptrend, you'll be able to know that the market is about to reverse. And like I said, the head and shoulder pattern consists of the left shoulder, the right shoulder, and the head. So once you see two shoulders and a head, it tells you that this is a head and shoulder pattern. So you wait for what? For a crossover. Before that, you must draw a neckline using your horizontal line, connect the lows, the support level, and wait for a crossover. That is a breakout. Once the breakout is confirmed, then you can enter your sell trade. Then your stop loss will be above the neckline, and then you target previous low as your what? As your take profit, or previous support level as your take profit. So that is how you trade the head and shoulder pattern. The next one we have here is the rising wedge. So the rising wedge here has to do with a connection of two trend line, right? You connect two trend line at the top and at the low, right? Because normally the price in an uptrend makes higher high and higher low, higher high and higher low. But here the price is not making any higher high and higher low. Instead, it's just ranging upward. We call it upward range. So you connect the resistance level and you connect the support level using two trend line, because clearly you can see that the price is not able to break through these highs, right? Instead, the price is just consolidating in an upward move, but the price is not breaking the level, it's just consolidating in an upward move. But for you to be able to trade this, you should be able to draw to a trend line. You connect the first trend line at the lows, then you connect the second trend line at the highs. So you wait, because in this scenario you cannot buy from the support level and sell from the resistance level, because sometimes the rising wedge can converge. It can be very, very tight, so there might be no room for you to trade. So what you should be waiting is a breakout. So what you do is you wait for a breakout. Right now you have already connected the trend line at the lows, and you have connected the trend line at the highs. So what you are waiting is for price to break below the trend line at the low, that is the support level. So if price eventually breaks below the trend line at the low, you wait for the candlestick that caused the breakout to close. You must wait for the candlestick that caused the breakout to close. So once the candlestick that caused the breakout closes below the trend line, that confirms a breakout. So you enter a sell trade, and your stop loss will be above the highs, above the trend line at the resistance level, above this trend line at the resistance level. And where will be your take profit? Your take profit will be at the previous low or support level. That will be your take profit. So for you to be able to identify a rising wedge, you should identify them at the resistance level after an uptrend. When the market is in an uptrend and then gets to a resistance level and begin to do what? Consolidate in an upward move. So you use a trend line to connect the highs and the lows, then you wait for a breakout below the trend line. So if the price breaks below the trend line, that gives you a confirmation that the trend have changed from an uptrend to a downtrend. So that is when you are expected to place a sell trade, and your stop loss must be above the resistance level, the upper trend line, and then your take profit must be at the previous low or the previous support level. So this is how you trade the reversal chart pattern for an uptrend. Then when we come for the downtrend, we have the double bottom. So the double bottom looks like a W. It looks like a shape of a W, right? So normally in a downtrend, the price normally makes lower high and lower low, right? It makes lower high and lower low. But when the price could not make another low, right, it means that the price cannot go further down, because normally if a downtrend is in progress, the price normally breaks below previous support level, right? If the price makes a lower low, then makes a lower high, the next one the price is going to break below the lower low, right? So that tells you that the downtrend is still in progress. But in this scenario, the price was in a downtrend, makes a lower low, then makes a lower high. Normally the price is supposed to break below this previous low to confirm that the structure is still in progress, but instead the price got to this low, and instead of breaking below it, the price reversed from it and continue heading up, forming a shape of a W. So this is what we call the double bottom chart pattern. So once you identify this type of pattern at a support level, what you should do is use the horizontal line to draw a neckline at the resistance level. So this now becomes a resistance level, because this is where the price got to. The previous high becomes what? A resistance level. So this is where the price got to before it's now retraced down and form the double bottom pattern. Like I said, the double bottom pattern looks like a W. The shape looks like a W. So once you identify this at a support level, you should be able to draw a trend. You should be able to connect the highs with what? A horizontal line. So this is what we call the neckline. So once you connect the highs, that is the resistance level, with a horizontal line, it is not known as the neckline. So what you will do is you wait for a breakout. So if the price eventually breaks above the neckline and closes above it, that confirms a breakout. It tells you that the trend have changed from a downtrend to an uptrend. So the sellers are not able to push the price down, rather the buyers have stepped in and were able to push the price up. So after the breakout, you place a sell trade and your stop loss will be below the neckline or at the support level, right? And where will be your take profit? Your take profit will be at the previous resistance level, right? That will be your take profit, because that is where selling pressure can come in, at the resistance level. So once you confirm a breakout, you place a buy trade at the close of the candlestick that caused the breakout. You place a buy trade, and then your stop loss will be below the neckline, right, or at the support level. And where will be your take profit? Your take profit will be at the previous resistance level, because that is where selling pressure can come in. So this is how you trade the double bottom chart pattern. So the next one we have here is the inverse head and shoulder pattern. The inverse head and shoulder pattern is the opposite of head and shoulder pattern. So the inverse head and shoulder pattern is almost the same as the head and shoulder pattern, but in opposite form. So here the market was in a downtrend, making series of lower high and lower low, lower high and lower low. That tells you the market is in a downtrend, right? You can see the lower low, this is the lower high, then this is the lower low again, right? This is the lower high. Now normally, if the price is in a downtrend, the price is supposed to break below previous supports, right? Previous support. So if the price keep on breaking previous support, it tells you that the price is currently in a downtrend. But in this scenario, the price makes a lower low, then makes a lower high, then makes a lower low. That is, the price now breaks below the previous low and now makes a lower low. But instead of price to make another lower low, the price now reverses from this previous low. Rather, the price could not get to this low. Instead, it reversed from this previous low. This tells you that there's a strong buying pressure here. So this tells you that the sellers could not push the price further. Now, what you do is, once you have confirmed these two resistance level, you simply plot out your trend line and connect these two resistance level. So it now becomes what we call the neckline. So once you connect these two resistance level, you now wait for a crossover, that is a breakout. So if the price now comes back to this previous low, reverse, and then breaks above this neckline, this resistance level, it tells you that the trend have changed. But before that, you must wait and confirm the breakout. The price must close above the neckline. So once the price closes above the neckline, that is when you can take a buy trade. So once you've confirmed the candlestick that causes the crossover closes above the neckline, you place a buy trade here. Your stop loss will be below the neckline. And where will be your take profit? Your take profit will be at the previous high, that is the resistance level, because that is where selling pressures can come in. So once you are able to identify this at the support level, you should know that this is clearly a reversal pattern from a downtrend to an uptrend. And like I say, the inverse head and shoulder pattern is the opposite of the head and shoulder pattern, because in the inverse head and shoulder pattern, it also have two shoulders and the head, the right shoulder, the left shoulder, and the head, just like the head and shoulder pattern, just that they are opposite. So once you are able to identify the inverse head and shoulder pattern at a support level, it tells you that the buyers have stepped in, the sellers cannot push the price down, the buyers have stepped in and they are going to push the price up. So like I said, you must wait for the price to close above the neckline for you to place a buy trade, and your stop loss must be below the neckline or at the previous support level. So this is how you trade the inverse head and shoulder pattern. The last one we have here is what we call the falling wedge. So the falling wedge is the opposite of the rising wedge. So in the falling wedge, the market was previously in a downtrend, making lower high and lower low, lower high and lower low. So now, instead of the market to make lower low, the market could not make lower low. Rather, the market began to consolidate in a downward slope. So this is a consolidation in a downward slope. You can clearly see the market is just consolidating, unable to break below the previous low, because in a downtrend, the market keep on breaking previous low, forming a pattern of downtrend. But in this scenario, the market could not break below the previous low. Rather, the market began to consolidate in a downward slope. So once the market is consolidating in a downward slope, what you should do is you plot out two trend lines, connect the lows and the high. So you connect one trend line at the lows and you connect another trend line at the highs, and you wait for a breakout at the upper trend line. So your target should be at the upper trend line because the market is already at the support level. So your target should be at the what? At the upper trend line. So once the price breaks above the upper trend line and closes above it, this confirms a breakout. So what you will do is you place a buy trade at the close of the candlestick that caused the breakout, and then your stop loss will be below the lower trend line. That is the support level. So your stop loss must be below the lower trend line, and your take profit must be at the previous resistance level, right? Because that is where selling pressure can come in. So make sure you wait for the candlestick to close above the upper trend line to confirm the breakout before you can place your buy trade, and your stop loss must be below the support level, that is below the lower trend line, and your take profit must be at the previous resistance level. So this is how you trade the reversal chart patterns. So honestly speaking, once you're able to master this chart pattern, you'll be able to trade it profitably using price action, right? You must use this chart pattern alongside with price action. You don't trade them alone. You must combine it with price action so as to get a good trading setup. So my advice is for you to go and backtest this reversal chart pattern on a demo account. Look for a chart and know how you can be able to identify this reversal chart pattern. So that is all I have for you in today's video. So this is how you trade the reversal chart pattern. So my advice for you guys is to go to your demo account, backtest this strategy, look for a pair and look for these chart patterns. See whether if you can be able to identify them on a chart, and then you can also backtest them to know how they are. Honestly speaking, if you can be able to master chart pattern, you'll be able to trade the forex market profitably alongside with your trading arsenal. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I publish new content. I will see you again in my next update. Enjoy the rest of your day. Bye.